this is Natalie with Kaladi Tax. I wanted to talk to you today about how your rental properties are taxed, what amount of tax you're going to pay on them, and how we calculate that. So the first thing to keep in mind with your rentals is that they are taxed at your ordinary tax rate. This means whatever you pay on your W-2 income, that regular bracket that shows up on your tax return, that's going to apply to your rental income as well. There's no special tax brackets for rentals. So that's part one. Keep that in mind. Part two. On your W-2 income, your earnings from your job, you pay payroll taxes, right? When you get your first check and you find half of it's missing, it's that FICA, Medicare, Social Security, all of these little taxes that come out of there. On your rental real estate, those taxes aren't applicable. So you will basically give yourself a 6% raise just by having rental income over earned income, right? You're paying less taxes on it right off the bat. So this puts more money in your pocket. So those are the first two things to keep in mind with rental real estate. It's taxed the same as your regular income, except you don't pay those payroll taxes. All good so far? The next thing to keep in mind is how we figure out the amount of income that's going to be taxable. So on your rental, you are allowed to deduct all of your ordinary and necessary expenses. So what that means is there's obviously the clear ones, right? You have your rents that come in, and then you get to deduct your mortgage interest, your property taxes, any property management, repairs, all of those things. Where it gets a little tricky for people is you will hear and you'll read how your rentals should have a loss on paper. And people think, well, why would I want properties that are going to lose money, right? You don't. If your properties are losing money, that is a whole different story. What this means is that rentals are allowed to deduct something called depreciation. The way depreciation works is on an asset, like a building, right, that lasts for multiple years. Basically, the IRS says that instead of deducting the full cost the year you buy it, well, it's going to have a use for a long time, so we're going to deduct a little bit each year of its use. So on residential real estate, on single-family houses, this is 27 and a half years. So what this means is you buy your property, you then need to figure out the value of the building versus the land. You can't depreciate land, doesn't have a life, it's there forever. So all we get to depreciate is the building. So there's a few ways we can figure that out. The most common one is to go to the tax assessor website, right? Go to your county website and see the amount that they allocate for building and land and figure out what that percentage is, and then apply that to what you paid. So that's the easiest way. You can also use your appraisal. If your appraisal has a good land value versus building, we want more value to building. This gets you a bigger depreciation deduction each year. Okay, so you're going to figure out how much you get to depreciate, and then that amount for the building value is taken over 27 and a half years. Now, keep in mind there's a few weird nuances to this too. There's some stuff of a residential rental that can be broken out and taken over a shorter timeline. There's very few items and it's very particular. So I recommend working with a tax professional to try to do that, because what I see regularly is when people do apply that, it's to all the wrong things. You can't take a water heater over 7 years. You can't take, all new windows over 7 years. Things like that are part of the building and they're structural. They're 27 years. But things like appliances, that's not attached. That's not part of the building. We can deduct that over a shorter time span and potentially apply bonus depreciation. So with your depreciation, the ideal scenario and how you end up with a loss is, say for the year, you have your rents, you have all of your regular expenses, your mortgage, interest, repairs, all of that. And at the end of all that, then we get to take depreciation. So let's say the depreciation is $5,000. So right now, at the end of the year, in your bank account, let's say you have $3,000, right? The rental made you $3,000. It's cash, it's tangible, it is there in your bank account. On your taxes, though, we now get to deduct another $5,000. Now, this is the deduction where you didn't have a cash outflow. You didn't have to write a check to get this depreciation. So what that means is at the end of the year, you have money in the bank, you made money, but on your taxes, we get to deduct that depreciation and have a loss. So this is great. This is kind of the snowball, the perfect effect of real estate. You get to make more money, you get appreciation, you get these tax benefits. And so not only are you taxed at a better rate to begin with by not paying those payroll taxes, we also now get to deduct this kind of, not imaginary deduction, but one that didn't cost you any money. So now at the end of the year, you have more money, you pay less taxes, and you get to own this property that's going up in value hopefully in the future. So that's kind of how real estate breaks down tax-wise and why it is so desirable for people. And when you hear about people who don't pay taxes, there's a good chance it's because of real estate. It's because of this. So like we said, we've got that loss on one property, right? Because we made $3,000, but we were able to deduct $5 in depreciation, right? So we have a $2,000 loss on paper. Now imagine if you had 20 properties or 50 properties and you get that same thing. So that is why people love real estate for taxes. So that's how your real estate is taxed. We want to generate these losses. Check out my video on passive losses because there are some rules with them. There's some strategies we need to apply. Not everyone gets to deduct the losses every year. So check out that video on how those losses work and how we can maximize them, and make sure that you are taking the best advantage of your tax situation. Thanks, guys.